you're in Turkey and you want to buy gold for a year forward, the guy says, sure, I'll sell it to you. You don't have to pay for a year. It's going to be 15% higher than the spot price. In Japan, in yen, he's going to say, okay, I'll sell it to you for 1 year forward. It's going to be the same as the spot price. This is for you right now looking to buy the stuff. There's no expectations. There's no anything. This is the actual real prices you face as a jeweler, as a gold miner, when trying to decide what to do with this gold you're going to be producing in a year or the gold you're going to need to buy a year from now. These are your choices.
And these are directly affected by the interest rate.
They are a direct function of the interest rates.
You mentioned the politically charged nature of the word inflation, and you described what the academic definition of inflation is. Can you describe it again a little more slowly for me? Because I think that was the first time that I heard it.
Okay, well, it's gotten blurred a little bit too, but it's what they call it what is the continuous increase in the price level? So if inflation is, if it's the price level, whatever that is, and it's the entire price level in some kind of weighted average, it's a concept that doesn't have a precise definition, by the way, is continuously increasing at 6%, then right now we're in a continuously, the inflation rate now would be 6%. But if you ask the Federal Reserve what the inflation rate is, they can tell you what it was last month. It was 0.6, which annualizes to 6.8. They can forecast it for the next month or out there, but they don't have a number for, and that's for CPI, of course. That's not for the price level. They can't tell you what the continuous rate of change for the price level is at any given point in time. It's not something that's conceptually accessible.
Right. Well, it's not like you can put a thermometer in the air and go, okay, so that's the price now. And then 1 second later, this is the price. So we can stick it into the calculus equation and say, okay, here's the difference.
Right.
Yeah.
Right. You can take a small difference and analyze it or whatever. So when I read the literature, I come back to, and I look at how we've had inflation, the price level defined and inflation defined in fixed exchange rate, floating exchange rate. I come up with this, that the rate of inflation is the term structure of prices faced by today's agents when they make decisions today. So, for example, if you look at the price of gold for delivery today, it might be $1,800 an ounce. But you can go to the futures market and see what the price of gold is going to be if you want it delivered a year from now. Say, okay, I'm a jeweler. I'm going to need gold for the next 5 years. I'd like to lock in that price. How much will it cost me to have, 100 ounces delivered today? And then I want another 100 ounces delivered next year, and I'll pay you for it then. And I want another 100 ounces a year after that, and another 100 ounces. You can go to the futures market and get a price for all that. And it turns out the price is affected almost entirely by the interest rate. So if interest rates are zero, the price is pretty much the same, whether you want to buy it for today, tomorrow, a year from now, or 10 years from now. But if interest rates were raised to, let's say, 10%, and the price of gold today was $1,800, and you said, okay, but I don't want to pay for it now. I want to buy my gold for delivery a year from now. It's going to be 10% higher. Because if the person gets paid today, he gets to put his money in the bank at 10%. So if he has to wait a year, he's going to lose that 10%. And by you not paying for it for a year, you get to keep your money in the bank at 10%. So you're going to gain that. So the indifference levels to both sides would be 10% higher. And the futures markets, the prices for what's called forward delivery, reflect exactly that for all the non-perishable commodities, all the like copper, steel, and things like that. Unless you've got some extraordinary situation of a shortage or storage costs are very high for some reason. But under, normal assumptions about storage costs and whatnot, the prices you have to pay to buy something for delayed delivery go higher according to the interest rate. So let's say you want to buy a house and you've got a builder who wants to build a house for you. The materials today cost $100,000, but you're not going to be able to, you're going to pay for that house a year from now. Well, he has to go buy all the materials now. He has to borrow the money at 10% or use up his cash that would have been earning 10%. And over the next 12 months before you're finally going to pay him for it. And so the price of that house is going to be higher. Now, some of it, he doesn't pay for it till the very end. Some of it he pays for early, but it's probably going to be $107,000 or something. his cost for things that today cost 100,000. And if the interest rate is 10%, and if you bought all the materials a year from now, they'd be 110,000, because if he contracted to get them now but wasn't going to pay for them until you paid for the house a year from now, that's going to add to the price of the house. So that positive interest rate adds to the price of somebody buying a house because of the time value of money. Okay, and so if interest rates were zero, then that wouldn't be a factor, because he can borrow money at zero, and he doesn't care whether you buy the house now or a year from now.
Right.
There's no time value of money. So what I say is, so we have what I call the term structure of prices. How much something costs for delivery today, how much it costs for delivery a year from now, 2 years, 5 years, 10 years. And that term structure of prices is either somewhere between flat, say zero, which it would be in a case of like Japan, which has a zero interest rate policy where the 10-year rate is also at zero. And it could be increasing at 15% a year in a situation like Turkey, where the interest rate is 15%. And so the term structure of prices that today's agents face when they're making buying or selling decisions, I call that the academic definition of the rate of inflation. And that term structure of prices is for pretty much the entire price level. It works for sellers and buyers. So if you're opening up a gold mine and you're going to buy all this stuff, and then your gold's going to be ready for sale in 2 years, you want to know what the price is now for gold that's going to be delivered 2 years from now. So you look at the term structure of prices. If rates are zero, it'll be the same as today's price. If rates are 10%, it'll be compound 10% per year compounded for 2 years. It'll be that much higher. And you can lock that price in now for your price of gold. So today, business people, individuals, all agents today are faced with a term structure of prices for just about everything they're going to buy that's not for immediate delivery. And that is what I call the rate of inflation that they are facing when they're making their business decisions. Those are the prices they can lock in. That's the reality of what you have to pay right now for buying something for delivery in the future.
I've never heard you describe this before. So
basically,
this is fascinating.
The market actors' expectation of prices over the long run is what you're talking about.
No, I'm talking about right now. December 10th at 2:21 my time. If you're in Turkey and you want to buy gold for a year forward, the guy says, sure, I'll sell it to you. You don't have to pay for a year. It's going to be 15% higher than the spot price. In Japan, in yen, he's going to say, okay, I'll sell it to you for 1 year forward. It's going to be the same as the spot price. This is for you right now looking to buy the stuff. There's no expectations. There's no anything. This is the actual real prices you face as a jeweler, as a gold miner, when trying to decide what to do with this gold you're going to be producing in a year or the gold you're going to need to buy a year from now. These are your choices.
And these are directly affected by the interest rate.
They are a direct function of the interest rate. So when the central bank sets rates, it's setting the term structure of rates, either directly or indirectly. Japan does it directly, but the U.S. does it indirectly. And it is setting this. The rate of inflation is the term structure of the policy rate that's set by the central bank. So when the central bank raises rates, they're raising forward prices for everyone.
Well, because we've talked about this before, and this is one of the things in your.
Now, let me just add. This doesn't mean that the price will be that much higher in a year. It just means right now that's what you have to pay.
Right.
It might be lower a year from now, but I'm talking about right now. What you have to pay or not have to pay is determined by the central bank's interest rate policy.
Well, because we've talked about this, I would say almost ad nauseum before, that interest rates going up is inflationary. And the reason we always talked about before was because that's just handing out free money to people who already have money. This is the first time I heard this.
Rather than inflationary, well, to be precise, you'd say interest rates going up causes the price level to increase. It's a little bit different than saying the inflation rate, because the inflation rate is what we're facing now. The price level is something that changes moment to moment. So let's look at the price level today and what will cause it to change or not change. So the first thing you have to know about the price level is that we're in a market economy. And so markets are always setting prices based on relative value. That's all markets can do. They can't set prices based on absolute value. So if markets can tell you silver is going to be 20 times, or gold's going to be 20 times what silver costs. Is that about what it is? 10 times. It's 100 times. Gold's going to be 100 times the price of silver. So if silver's $20, gold's going to be $2,000 today. And as that changes and silver goes 22 and gold's 1,800, the markets are telling you gold is, 80 times silver or 90 times silver. So they can set relative value. But the market doesn't know the actual price, because first you have to tell it what currency. The market will tell you it's 100 times silver. If you say yen, they say, okay, then, in yen, silver is 2,200 and gold's going to be 18,000. In dollars, it's going to be $22 for silver and $1,800 for gold. In euro, it's going to be this. In Turkish lira, it's going to be something else. The market but you've got to give the market that information on absolute value. But all over the world, the markets that trade are going to give you the same relative value, no matter what the currency is. Silver times 100 is going to equal gold, or silver times 90 is going to equal gold. So markets determine only relative value, and no economist or financial person would disagree with this. But the absolute value, which tells them the starting point, what currency you're using, whatever, that comes from the outside. You got to tell them that. So the same model that's pricing things, you can tell it any currency you want, and it'll come up with the answer for that currency. It's just changing the numeraire. If you tell the model that we're going to be talking about pennies instead of dollars, and silver instead of $22 is 2,200 pennies, the market doesn't care. You just but it's got to get this information from the outside. It can't tell on its own whether you want the price in pennies or dollars or dimes or yen or euro. Okay, so number one, markets only set relative and determine and work. They determine relative value in difference levels on a relative basis. And that's all mainstream market theory, financial theory. Everything tells you that. I'm not giving you anything that's in dispute now. But the absolute value has to come from the outside. Now, what the economists say is, so where does the absolute value of the dollar come from? The starting point. And they say, what the prices were yesterday. And now markets now we can tell you how they're going to change. Well, where did that come from? Well, it came from the day before. Well, where did that come from? It came from the day before. They've got an infinite regression back to the Big Bang or something, or back to, they don't worry about that, because all they need to know is what's going to happen between today and tomorrow. So they've totally missed this, because they've missed the point that the currency itself is a simple public monopoly. And so the absolute value, the information that's external to the relative value model, is the prices government pays. And that can change day to day or not change day to day. And then once the markets know that, then they can sort everything out for relative value. So how can we explain this so it's obvious? So we need the government's money to pay taxes. Okay, the money to pay taxes comes only from the U.S. government. The dollars, the actual dollars, which are reserve balances at the Federal Reserve, they only come from the Fed. The Fed has to credit your account before it can debit your account. It can't. Nobody hacks into the Fed and puts in debits or credits. It doesn't work that way. They have to make the entries themselves. So what happened is they imposed tax liabilities. That's how our money story begins. Now let's just think of a property tax in everybody's house to keep it simple, so we don't have to figure out income tax rates and all that. But it all works the same. So it's a property tax in everybody's house. So we all need this money, these dollars that can come only from the government, or else they're called counterfeit, right? You're not allowed to bring your own. And are we going to lose our house and our car and our job and maybe go to jail for not paying taxes? And so we are now at the mercy of the government for what we have to do to get those dollars from the government. So it says, oh, you know what? You serve in the Army and we'll give you $50,000 a year. You sell us a door jam for this door in a submarine and we'll give you $100,000 for that. The government, we need the money. They tell us what we have to do to get it. And what they tell us to do, we have to do at the margin, the markets that becomes like a source of, that's the external information that the markets use for absolute value, and then everything else becomes relative value.
That's the structure that the government creates for the market, and then they're able to work within that structure.
So if all the government ever did, now in a gold standard, the government used to say, okay, we'll buy gold at $35 an ounce and we'll sell it at $35 an ounce. Okay, we're telling you what you have to do to get the money to pay the tax. You have to get gold at $35 an ounce, and you can pay the tax. You can get gold, and we'll accept it at $35 an ounce, and that's the absolute value. And then the markets, everything else becomes value relative to gold. Of course, gold's very volatile, so all the other prices are fluctuating like crazy as gold stays the same. But that was how it worked on the gold standard, and they had to conduct policy so that they didn't lose all the gold. They had to make sure taxes were high enough so that people needed gold so that they could be buying gold from people. So people would be willing to sell the government gold at $35 an ounce, which you could then use, and it would issue gold certificates to spend. And it didn't work very well. Every country that's tried it has wound up suspending it or going off because it doesn't function. But that's neither here nor there right now. So if the government said, okay, well, the tax is $5 trillion, and at the margin we're going to pay $50,000 for labor to anybody who wants a job, the market can then determine what everything should cost because they know what a day's labor costs. They know what people can work and produce things, and they'll sort that out. That's what markets do. They'll sort out the relative value. So let me stop and let you ask some questions here. So anyway, the price level is a function of what the government says we have to do to get their money. And that changes day to day. Fundamentally, when the government changes what it tells us we have to do to get the money. So when it says we're going to give everybody a 2% cost of living increase, it's making the money 2% easier to get. And will at some, begin to flow through the whole market structure, all the other institutional structure that's sort of non-market, the way contracts work and everything else. There's a lot of government institutional structure that filters this through the prices. And then everything will sort of adjust up 2% and, over time. So again, as a point of logic, the price level can only be a function of what the government tells us we have to do to get the dollars that we need to pay their tax. There's no other source of value. And has not been recognized by any of the mainstream models. And so they have inflation expectations and all these other things, which they're now showing don't work because that's not what it's about.
If everybody who's watching this now or recording could like, share, and subscribe it helps us out a lot.
Yeah.
I hate saying it, but it's just true.